Welcome back. We're joined now by our featured guest of the morning. He's Gavin Graham, Chief Strategy Officer at SmartBe Investments. First of all, Gavin, thanks for coming on the show again today. We're delighted always to have you with us. You've brought lots of talking points with you. Before we get rolling, I'd love to get your take on a meeting in the White House that is set for today. Jerome Powell, the chair of the U.S. Federal Reserve Board, set to meet U.S. President Joe Biden. Inflation and the state of the U.S. economy is the subject. Joe Biden, of course, would love to see inflation cool off. His popularity as president largely depends on it, and the fortunes of the Democratic Party in the midterm elections coming up in November of this year may depend on it as well. What do you think the conversation might be like between those two gentlemen today?
Well, glad to be here, as always, Paul. And it's like that sort of quote from the musical Hamilton, you want to be in the room where it happens. And effectively, what one would expect is Mr. Biden, as you said, saying to Jerome Powell, can you do something to get inflation down? And Jerome Powell saying, I'm going to keep raising interest rates by at least 50 basis points the next two meetings, which he said in public several times, and has not ruled out necessarily raising it by 75 basis points at some point, because that's the quickest way of getting inflation down. That probably isn't what Mr. Biden wants to hear, but it's realistically the only thing Mr. Powell can do to actually get a handle on inflation, because he failed to raise interest rates last year. He told everybody it was transitory. That was, what's the technical phrase? Oh, yes, wrong. And now, given that the impression is the Fed is very much behind the curve with inflation at 8% and interest rates still only at 1%, although if he raises it by 50 basis points two meetings in a row, we'll be up to, oh my gosh, 2%. He's got to raise it substantially further. Whether Mr. Biden will be happy with that is another question.
Yeah, Joe Biden's position is not an easy one. Inflation is not popular with voters. High interest rates are not popular with voters either. So what are you going to do? Okay, as I say, you always bring some great talking points with you. You're ready to talk to us now about inflation in the economy and in the market, and the role of real estate investments therein. What are your thoughts there?
Well, effectively, real estate is a good inflation hedge. At least that's the evidence from the last time we had these types of inflationary numbers, particularly the 1970s, but even in the 2000s. Part of the 2000s, of course, was the sort of the very lax lending standards. But the fact is that, yes, rising interest rates are regarded as not being helpful to property in the short term. And in fact, the REIT index, the Real Estate Investment Trust Index in Canada is off about 10% so far this year, which is a lot worse than the stock market. But it's somewhat ironic because actually the inflation, which is leading higher interest rates to rise, is actually good for the price of property. And the evidence is that in an inflationary environment, real estate is one of the few things that will actually retain its real value. In fact, it may even outpace inflation because the real value of the money that you borrowed, your mortgage or whatever, is being reduced by inflation, and therefore the burden is being reduced. Plus, you can do it with a lot of leverage. It's one of the very few things where you can actually buy an asset that's likely to appreciate in an inflationary environment with only 5 or 10% down. So real estate is something that investors should have in their portfolio. They should have exposure, not necessarily to all parts of the real estate market, but realistically, you ought to be looking at REITs now, especially as they have sold off rather more than they should have.
What about publicly traded real estate? You've touched on having real estate in your portfolios. You make the point in some notes that XRE, which is the, I think a lot of people would take as the benchmark real estate ETF that tracks the TSX REIT index, is down. Well, we've got it over the past 52 weeks up only 1.5%. That's 52 weeks. It's actually down on a year-to-date basis.
Yeah, absolutely. And again, given what's been happening to the price of housing, which is up 18, 20%, given what's been happening to the prices of other real estate assets, particularly things like warehouses and logistics and industrial estates, which have all been big beneficiaries of the whole COVID pandemic, it's very surprising it hasn't done better. In fact, over the last 5 years, when you've had probably a pretty good environment for real estate, you're only up about 15% in total in XRE, although, of course, you've been getting that excellent yield, that 3.5% yield. Therefore, one, you're going to get a good yield. Two, it's got some inflation protection because you can pass on rental increases. And thirdly, particularly if you're looking, for example, at apartment REITs, because with the price of real estate, of housing having gone up so much, a lot more people are having to, it's generation rent, you've actually got to rent. Interestingly, the rise in rentals has actually kept pace with wage growth. So actually renting as a percentage of your income is not a great deal higher than it was a few years ago. And that's obviously makes apartment REITs look attractive.